Dividend investing feels safe. You buy companies that send you cash. You see money hit the account. You do not have to sell anything. It feels disciplined. It feels conservative. It feels like the portfolio is paying you instead of you consuming the portfolio. But here is the uncomfortable math. If you had put $10,000 into SCHD near its inception and reinvested every dividend, by April 29th, 2026 it would have grown to about $59,761. Strong result. No argument. But the same $10,000 in VOO, the Vanguard S&P 500 ETF, with dividends reinvested, would have grown to about $76,408. Same window, same reinvestment assumption, a gap of about $16,647. In this test, the lower-yielding fund ended with roughly 27.9% more money. So was dividend investing a mistake? Not necessarily. That would be too simple and too biased. SCHD outperformed VOO in some years. It had a much smaller loss in 2022. It produces more visible income, and for some investors, that matters. The real question is not whether dividends are good or bad. The real question is this: is dividend income economically better, or does it just feel better? Start with the mechanical part that almost everyone skips. A dividend is not a bonus created outside the company. It is a transfer of value from the company to the shareholder. Imagine a stock worth $100. The company pays a $4 dividend. Around the ex-dividend date, ignoring normal market movement, the stock price is typically adjusted downward by roughly the amount of the dividend. The shareholder now has a stock worth about $96 plus $4 in cash. That can still be useful. Cash is useful, but it is not free money. This is why a total return chart does not ask how much cash arrived. It asks, what happened to the entire economic value? Price appreciation plus dividends equals total return. If you only look at the dividend, you are looking at the packaging. If you look at total return, you are looking at the package plus the box it came in. Before comparing returns, we need to be fair about what these funds are. VOO tracks the S&P 500. It is broad U.S. large-cap exposure, and as of Vanguard's March 2026 fact sheet, it was heavily exposed to mega-cap growth and technology. The fund listed a 0.03% expense ratio, a top 10 concentration of 37.8%, and information technology at 32.9% of the portfolio. SCHD is different. It tracks the Dow Jones U.S. Dividend 100 Index. The index screens for U.S. companies with a record of dividend payments and fundamental strength measures, including cash flow to debt, return on equity, dividend yield, and dividend growth. As of Schwab's data, SCHD had a 0.060% expense ratio, a 3.34% SEC yield, a 3.44% trailing 12-month distribution yield, and 104 holdings. So this is not a clean experiment where one fund simply pays dividends and the other does not. VOO owns the market cap-weighted S&P 500. SCHD owns a rules-based dividend portfolio. You are comparing different factors, different sectors, different valuations, and different cash flow profiles. Now, let's run the test from SCHD's inception window. Total Real Returns reports that from October 20th, 2011 through April 29th, 2026, with dividends reinvested and inflation turned off, VOO compounded at about 15.03% per year. SCHD compounded at about 13.10% per year. On $10,000, that is about $76,408 for VOO versus about $59,661 for SCHD. Again, SCHD did not do badly. It compounded at a double-digit annual rate. But the higher dividend yield did not translate into the higher ending value. This is the first major lesson. Income is not the same as return. A portfolio can pay more cash and still compound to less total wealth. Another portfolio can pay less cash and still end with more wealth if price appreciation makes up the difference. But a credible analysis cannot stop at one ending value. SCHD had years where it looked much better. In 2022, VOO was down about 18.17%, while SCHD was down only about 3.26%. That is a huge difference for anyone living through the drawdown. SCHD also led in 2016, slightly in 2021, slightly in 2013, and in the partial 2011 window. And through April 29, 2026, SCHD was ahead year-to-date, up about 15.63% versus about 4.65% for VOO. So the honest statement is, not VOO always wins. It does not. The honest statement is, high dividend yield did not guarantee better long-term total return, and the winning fund changed by regime. The strongest emotional argument for dividends is not performance, it is spending. A dividend investor says, I do not want to sell shares, I want to live off the income. That is psychologically powerful. Selling feels like destroying the goose. Dividends feel like collecting the eggs. But mathematically, cash flow can come from two places: automatic distributions or self-created distributions. If a portfolio has enough total return, an investor can create a synthetic dividend by selling a small amount. That does not automatically make the investor poorer than receiving a dividend, because the dividend itself already reduced the stock value mechanically. Using the April 2026 ending values and 30-day SEC yields for both funds, SCHD at $59,761 with a 3.34%. SEC yield produces about $1,996 of annual cash. VOO at $76,408 with a 1.16%. SEC yield produces about $886 automatically. To match the $1,996 cash flow, the VOO holder would need to sell roughly $1,110 of shares, bringing total cash flow to about 2.61% of the VOO balance. That sale can feel uncomfortable. It can create capital gains tax. It requires discipline. But arithmetically, selling shares is not automatically worse than receiving dividends. What matters is the total value left after the cash is taken out. Now add taxes. In the United States, ordinary dividends are taxed as ordinary income, while qualified dividends can be taxed at the lower long-term capital gains rates if requirements are met. That means dividends are not always taxed the same way for every investor, and retirement accounts can change the picture completely. But in a taxable account, dividends have one important feature. They can be forced realization. You receive the dividend in the year it is paid, and if it is taxable, the tax event happens whether you needed the cash or not. Using a 15% qualified dividend tax rate purely as a mechanical example, VOO's 1.16% SEC yield creates about 0.174 percentage points of annual dividend tax drag. SCHD's 3.34% SEC yield creates about 0.501 percentage points. The difference is about 0.327 percentage points per year. That sounds small, but compounding is where small numbers become visible. If two portfolios both earned the same 8% pre-tax total return for 30 years, and the only difference were dividend tax drag at these yield levels, a $100,000 account would end near $958,149 in the VOO-like case and near $875,251 in the SCHD-like case before considering final sale taxes, state taxes, NIIT, tax loss harvesting, rebalancing, or account type. That is an $83,498 difference in this simplified model. This does not mean high dividend funds are bad. In tax-advantaged accounts, the drag may be different. For investors who need cash, the dividend may be useful. For investors in a 0% qualified dividend bracket, the federal drag can be much lower. The point is simply that dividends are not tax-free magic. They are taxable cash flows under specific rules. Another reason dividend screens can mislead is that dividends are only one way companies return capital. Companies can also buy back shares. Buybacks are less visible to the investor because they do not arrive as cash, but economically, they can increase each remaining share's ownership claim. S&P Dow Jones Indices reported that S&P 500 companies spent about $249 billion on buybacks in the third quarter of 2025 and about $1.020 trillion over the 12 months ending September 2025. Over the same 12-month period, dividends were about $664.9 billion. In other words, a huge part of shareholder return can be invisible to a dividend-only screen. This is why yield can be an incomplete scoreboard. A company paying a low dividend but buying back shares may be returning capital. A company paying a high dividend but issuing shares or carrying weak fundamentals may not be as attractive as the yield implies. The form of distribution matters, but so does the source and sustainability of that distribution. At this point, it would be easy to make the wrong conclusion. Dividend investors are irrational. That is not fair. There are real reasons dividend strategies attract investors. First, behavior. Cash income can help people stay invested. If a dividend stream prevents panic selling, the behavioral benefit can be worth more than an optimized spreadsheet. Second, spending. A retiree may prefer predictable distributions, even if the total return framework says self-created cash flow is equivalent. Financial planning is partly math and partly human execution. Third, factor exposure. SCHD is not just a yield product. Its methodology includes dividend history and fundamental strength screens that can create exposure to mature, profitable, value-oriented companies. In some regimes like 2022, that profile can be very helpful. Fourth, valuation and concentration. VOO's recent advantage came during a period where megacap growth and technology were very strong. If the market regime changes, the relative result can change. The balanced conclusion is not that dividends are useless. The balanced conclusion is that dividends should be understood as one component of total return, not as a substitute for total return analysis. The most dangerous version of dividend investing is yield chasing. A high yield can mean a generous company. It can also mean the stock price has fallen because the market doubts the dividend. FINRA's investor education materials make the basic point clearly. A company may pay dividends, but it does not have to, and the amount is not guaranteed. Dividends can be cut or eliminated. So a 6%, 8%, or 10% yield is not automatically a gift. It may be a signal that the market is pricing risk. The question is not how big is the dividend. The question is, can the company afford it, and what total return am I receiving for the risk? Here is the framework. Do not ask, are dividends good? Ask what you are optimizing. If you are optimizing total wealth, measure total return after fees and taxes. If you are optimizing spending cash flow, measure reliability, drawdown behavior, dividend sustainability, and withdrawal rules. If you are optimizing tax efficiency, account type and tax bracket matter more than the word dividend. If you are optimizing behavior, ask whether the income stream helps you stay invested or whether it tempts you to ignore diversification. And if you are optimizing factor exposure, be honest that SCHD is not simply income. It is a dividend-screened, value-tilted, quality-screened equity strategy with sector weights and turnover. Dividend investing feels safe because cash is tangible. You can see it. You can spend it. You can count it. But the market does not reward feelings. It rewards economic value. A dividend is part of that value, not extra value on top of it. In the VOO versus SCHD case study, the higher-yielding fund produced more visible income, but the lower-yielding broad market fund produced more total wealth over this historical window. That does not make VOO the right choice for everyone. It does not make SCHD wrong. It means the question has to be asked honestly. After taxes, after behavior, after drawdowns, after portfolio composition, what are you actually optimizing? Because in investing, income can feel like safety. But the math is always asking a deeper question. What did you give up to get it?